Hey everybody, this is Jose Blasco. This is a sound check. Please go ahead and type a quick hello on the chat box so I know you hear me and sound is good. So we are ready to get started. Please let's do that so we can start on time. That would be appreciated. All should be good, but always good to confirm, isn't it? So that's what I'm doing. Very good. I'll turn on my video stream as well as we are ready to get started so I can say hi from the bottom right of the corner, as always. That's where I put myself on the screen. Very good, Luis. How are you? Good to see you, Luis. Good, everybody. Good to see everyone. Wonderful. So let's get started with our session, guys. Today it's February 4, 2021. Today is options, isn't it? So options with options. Options give you options. We're going to be looking at the market, see what the market has to offer. The beauty of options is that we can truly adapt very precisely to what's possible. Sometimes options are expensive, we sell them. Sometimes options are cheaper, we buy them. Sometimes the markets are moving, so we get directional. Sometimes some markets are not moving, so we get non-directional. Again, the sky is the limit, and that's the beauty of options. The key is to not to kind of like be a let's call it a single option strategy guy, in the sense that you always do the same, because that may work very well 3 years in a row and suddenly is a complete mess because market conditions have changed. Okay, so it's important to always be adapted to the various market conditions, which depending on which stocks you trade, those options are going to be in a different place, and it's important to be adaptable and that way take advantage of the market opportunities safely. Okay, before we get started, I'm going to highlight the disclaimer on the upper left part of the screen, as always, so please read it carefully. I'm giving you a little bit of time there to read it. It's just a couple of paragraphs. But it's important stuff, even though it's legal stuff, if you wish, and you may say, oh, that's a bit boring. Well, no, it's not. It's important, especially for the ones of you that you are new to trading. You need to understand the risks attached to trading. You may use paper money, real money, larger size, smaller size. It's really important that you know what you're doing and the implications. Okay, so make sure that you read it carefully. Anyway, with all of this said, the session is now officially introduced, so I am ready to jump on TradeStation to begin all the planning of the trades. Just give me 1 second, guys. I'm just confirming something here. Yeah, everything is good. So again, as I was saying, I'm ready to begin the planning of the trades. And as always, the way I like to break down the session is in 3 parts. First, we look at the markets, get to understand the market condition, as I just mentioned a minute ago. From there, we look into trades that we may have in the account, the trades that we planned before and we need to review, which today is going to be simple. Today we have none. Okay, no trade to be reviewed, so it's going to be quick to do that. And then we get into the most important part of the session, of course, which is when we're going to be looking at new market opportunities, plan the trades, and assuming the rules are met, then execute. And if the rules are not met, then jump into another market opportunity until the rules are met. Okay, we don't break the rules, make up excuses to break a rule, to break the rules. We don't do any of that. We just have no emotional attachment to any market that we trade. We are totally emotionless, and if the rules are met, we trade. If the rules are not met, we pass. That's it. That's simple. Okay, good. So let's begin with the market. Okay, so what do we have from a market point of view? Well, from a market point of view, if I zoom in, we can see the S&P ETF here in a daily time frame. We can see the climate is unconfirmed, so there is some directional component to the upside. But the price action that is being produced as we speak has AutoClimate define a non-confirmed situation, meaning that odds are really not stacked in our favor in any direction so far. Okay, all of this could change later in the day, tomorrow, but so far, notice the dot is thin. Like for example, here it was a thin dot as well. Let me redraw this arrow. So it was a thin dot as well. Here, the dots were thick, and that means confirm. But today, it's thin, like the first case on the left, and therefore the market is the climate is not confirmed. So careful there, especially given the fact that we are entering a red UFO, which again with the S&P ETF, the probability for those UFOs to work, it's limited compared to if you were to look at the same on the S&P futures. So if I was to look at the S&P futures, we would have a different picture. Okay, probabilities are much better, but notice how that red UFO is gone. Okay, climate is still non-confirmed, so the futures are basically confirming, funnily enough, what the S&P ETF is doing. But the difference is that there is no red, there is no sell-on field orders left, and careful with that one because probability is more. On the futures, obviously being a 24-hour market and much larger than the S&P ETF as an equity product, and therefore, so far, I would say the directional component is to the upside. So because there is no red UFO, you would say the market is likely going to go up, but be ready for anything really because the climate is not confirmed, and therefore there is no strength in any particular direction so far. Okay. In this particular time frame in the daily time frames. Okay, so careful, and when looking at the VIX, which is the implied volatility of options, sorry for that, guys. So when we look at the VIX, which is the implied volatility of the options, so what do we see? Well, we see the VIX pointing at 22, spectacular drop since the last week where we hit 30 something, and now we are back to the 22. So again, it is looking like everybody is so relaxed. Everybody thinks the market is going to the moon. Everybody's getting calmer. There is no urgency in buying options for hedging or protection, and all of those more are reasons for the VIX to go down and down and down. So options are becoming cheaper. Okay, options are becoming cheaper. So that is translating on the fact that when you look at the scanner that I did run before the market started today, you can see that I've been reported 8 opportunities. So it's a relatively short list. You would expect a longer list given the fact that the S&P has a non-confirmed climate. So you would expect many stocks to be, let's call it, quiet, not doing much. So you would expect your non-directional list to be more. But what's the problem? The problem is that for you to do non-directional trades, you need options to be overpriced. And look at what's happening to the VIX. The implied volatility index is dropping, so options are becoming cheaper. So it's difficult to find opportunities with good premium as well as quiet markets, which are higher probability for non-directional trades. And therefore, our list is 8 stocks. Okay. Now, this is not bad. I mean, again, I wish we could have, a list of, 100 symbols every time. So then it's for sure we always have something to trade. Trading is not like that because our job as traders is to be picky, to be selective, and to trade high probability. And therefore, we trade quality, not quantity. But at the same time, 8 opportunities with non-directional, maybe a few more with directional. So again, as you keep looking at those opportunities, a few times a week for sure, you get some trades that you could execute, and that's good enough, I would say. Again, it would be great if we have more. We don't have control over that. The market does. And we're not going to break the rules or get into the scanner and change the parameter just so we get more opportunities, because then we'll reduce the odds. Okay. So if you do it based on a plan and based on a specific set of rules different than the ones I'm using, then it's fine. But if you were to do it out of, let's call it desperation, because you're like, hey, I want to trade more. I just need to trade more just because I feel like trading more. Well, then that would be a problem because, you're not being realistic with the market data provided to you. Okay. So always stay disciplined, stay professional, stay calm, right? And let the market come to you instead of rushing or, jumping on trades or making up trades or forcing trades. That's not the way to do it. So I'm going to come back to this list of opportunities in a minute. Again, in this process of understanding the market, notice how directional trades to the upside are a few. They're all new, by the way, blue color symbols, so they were not available yesterday. So again, this is telling you about how the market is defining certain direction to the upside, as we saw from the climate point of view. We can see that directional opportunities to the downside is only one. So again, there is a directional component to the upside. And we do have a few more stocks than the last week, if you think about it, because options are becoming cheaper with a VIX of 22. And as options become cheaper, we find more opportunities to be directional, because let me zoom in. Okay, let me zoom in. directional opportunities means DBT. Okay, and DBT is what? Well, DBT means debit strategies. In other words, buying options, and when you buy, you want to buy cheap. Okay, so you want the VIX to go down. You want the implied volatility of every one of those options for those particular individual stocks to go down. So you are in a situation where you are likely going to buy underpriced options. Okay, from a neutral point of view, we also have a few opportunities to neutral long, neutral short, also a few, but notice is not too many. And again, I'm repeating myself. Why is that? Well, because the VIX is low. So neutral or non-directional means selling options. And again, if the VIX went down, so options are more in the side of underpriced than on the side of overpriced, and therefore the list is shorter. Okay. Good. So with all of this said, we are ready to go. Now, why am I giving you all this detail? Because my intention, which is probably the same as yours, is that today is great. You join me. We are putting the trades together. That's great. But what about tomorrow? What about later in the day? What about the day after? Right? So maybe you are planning the trades by yourself, and sometimes you may be in front of market data, and you're like, why is this happening the way it's happening? Right? So I'm kind of sharing the thinking behind behind what I do. So somehow, as you get to see certain, let's call it market behaviors happening as markets go from cycle to cycle, you kind of realize that, oh wow, this is what Jose said once, right? And somehow that will help you not only to practice more and practice better, but also practice with more confidence, which is important for a trader to be understanding what's going on. Because if you are not understanding what's going on, there's no way you can be confident to click the button. Where if you understand why things happen the way they do, then you are in the right path to trade well. Okay, good. Lots of information as always. You guys know I tend to talk fast as well, so hopefully it's all good. Feel free to type, feel free to chat, guys, on the chat box. Don't be shy. If you have any question, feel free to type it, and I'll be regularly consulting the chat box. So I'll be giving answer to all those questions that you guys may have. It doesn't need to be questions, by the way. It could also be, hey Jose, I did this happened to me, or hey Jose, there is an opportunity there, that I'm looking at. So again, it doesn't necessarily need to be questions. Okay, Leland, good to see you, my friend. Very nice to see you. Very nice to see you, Nicole. Very good. So let's go for it, guys. We're gonna start with non-directional trades, and as always, sorting the list from more expensive to less expensive. The one on the top is Facebook. So let's load Facebook and see what we got in front of us. So first of all, when it comes to Facebook, when it comes to doing a non-directional trade, it's looking good because the next earnings date happens to be April 28, and being April 28 and today being February 4, we got plenty of dates from now until that earnings date that allow us to use next Friday expiration or next Friday expiration or next Friday expiration to set up our non-directional trade. So we have many choices for us to do the trade. Another thing that we have is that we need at least 48%, and we get 48%. Okay, if I switch to pre and post market instead of regular session data, we get 47.77. So that is not good. Okay, it's very close to 48, but it's not 48. So we're gonna stick to regular session data for this trade. And then the other rule we have for non-directional trades is to have at least 2 UFOs above and 2 UFOs below. And definitely we have 2 UFOs above, okay, and multiple UFOs below. So it does seem that, we may have an opportunity to do something with Facebook from a non-directional point of view with so many UFOs above and below. Now, visually speaking, and again, this may come from some experience. How are you, Marie? It's good to see you as well. Very nice to join us. So again, I was going to say something coming from experience, but apart from sharing it from that point of view, I will share it in a second from a statistical point of view, meaning that if you don't have the experience, so when you practice by yourself, you would conclude the same thing I concluded out of experience. Okay, so no worries about that. But basically what I'm trying to say here based on experience is that visually speaking, if you think about where the current price is and where that second UFOs above is, it's quite far. Okay, we have all that distance to travel to get to that UFO. So in other words, if I load an option chain, right, and if I was to look at the extreme of that UFO, which is 303.6, okay. So if I was to look at options, okay, and on the upper side is going to be calls, isn't it? So if I was to look at options, call options, around 303.6 on Facebook, and I was to use, let's say, next Friday expiration, which is only 1 week away from now, 8 days from now, I'm pretty positive that even though Facebook has options with certain level of premium built in, okay, based on what the scanner said, I'm pretty positive that 300 will pay very little, and how much is little is 8 cents. Okay, so this is coming from experience. Okay, now what if you don't have the experience? Because I mean, why would you want to sell an option for 8 cents, right? What a waste of time. Reward to risk ratio, commissions that you pay to the broker would, basically eat everything up. So now, how did I kind of knew that was going to be the case? Well, it's experience. But what if you don't have the experience? Well, you just come to the desired expiration date, okay, and let's say it's next Friday, and you would analyze and sell. Let me do this again. Analyze and sell an iron condor, and you just select any strike. It doesn't matter. And the moment, you have the right expiration date here on your analysis tab, and you have set up -1 and +1 standard deviation above and below, you will now realize where statistics suggest price would go, which is 278. And again, if I draw a dotted line around 278, okay, I'll make it dotted. Okay, I guess now you understand why I said 303 is far, because from now until next Friday, statistics suggest that price is not likely going to surpass 278. So if I was to do a trade around 303, well, it's a very high probability trade, but that's why I get paid so little, because it's almost impossible for price to get there. So that's why they pay you very little to take that risk, because the risk is very low. Okay, now what if price was to get there? Then you would get a proper loss in exchange for only 8 cents of profit. That is not how we trade. Okay, you want to get paid more. Okay, so again, long story short, when the UFOs are very far away, unless you have a crazy amount of premium built in the options, you will be kind of forced to go out in time, instead of 8 days, maybe 15, maybe 22, to find the minimum 35 cents, which is our bare minimum for us to accept a trade. Okay, so if I was to look at 15 days from now, and I still look at the 305, for example, well, now it's paying 22 cents, which is more than 8. Okay, so we are getting closer to 35, but even using February 19, which is 15 days from now, we are not being paid enough. So let's check February 26, and let's see what's going to happen with the 305. Okay, and now we get paid 54. Okay, which that is something I'm happy. Okay, because it's 35 or more. I'm not saying the trade is approved. We still need to look at more things, but that is a good starting point. So if I was to do this, okay, instead of working on the chart, the first thing I would do is working on the UFO price, which was 303.6. So I'm looking at 305, and make sure I got the premium I need. So now I know that my starting point is going to be February 26, and then I go back to my analysis tab and change these to February 26. So now I can get an updated value of what statistics suggest on how far price should go from now until that date, which is 287.3. Knowing that 287.3 is the price, I can now update my line and notice how, if I was to sell options in this location above the UFO, is still a place on the chart where it's very unlikely for that market to arrive there from now until February 26. And now, instead of being paid 8 cents, I'm being paid 50-something cents, which I guess you are with me. This is now making some sense. Okay? Talking about cents. A very, very bad joke. So, anyway, so I just got myself surprised on such a bad joke. Anyway, so 26th of February may work, but I want to add one more comment, okay, which when you go out far, when you go far out, sometimes we cannot fix the problem I'm about to point at. And if that's the case, we may or we may not accept the trade. But I want you to notice, and this is just to save you time in your planning. I'm just sharing with you tips that will help you plan trades faster when you do that by yourself. Notice how in strikes that are closer to the current price, we have strike price increments of $2.5 at a time. Okay, 270 to 272.5 to 275 to 277.5, etc. But notice that as we go further out, now when we get to 305, the next one is 310. So in other words, we got $5 difference right there. And is that wrong or right? Well, it's not wrong and it's not right. If the reward and the risk is there and the trade makes sense, you can take it. But at the same time, to me, it's a little bit on the wrong side because of two reasons. Number one, if strikes nearer to price have nearer prices based on the strike price increment, it means that liquidity here is better and market makers are releasing more strikes. Where if here you have strikes that are further apart from each other, it means that liquidity is less, and therefore in order to get some trading for those strikes, market makers are releasing less strikes. And therefore, you may be suffering some slippage in there, right? That's reason number one. I mean, and again, you can always assess slippage by looking at the bid and the ask price. In this case, is 7 cents, so it looks fairly reasonable. Open interest, 400, 300 contracts. It's not amazing, but it's not so bad. Okay, actually, sometimes even though the strikes are further away here, because they are round numbers instead of decimal places, you get better open interest, for example, for the 310, okay, or the 305, 600 and 400, than what you get for the 297.5, where open interest is only 31. Why is only 31? Because it's at 0.5, okay, and normally 0.5 may get less liquidity. But again, the fact that the strikes exist, even though they may have less liquidity, tells me overall there is more liquidity in those strikes compared to those strikes that are further away. So that is one reason for a little bit of concern. I made you laugh, Christian. I'm happy about that. Somehow I laughed a little bit myself, but I mean, between us, it was quite bad. In any case, humor is good, even if it's a bad joke. So coming back to serious matters here. So reason number one why this was concerning is because of the liquidity issue I just mentioned. Reason number two, it's because I put myself in the shoes of you guys, and my understanding, my assumption is that while some of you are experienced and you are joining the sessions just to get better and to learn more, and the beauty of trading is that this is like a sport, right? You can always get better. And probably that's why we love it so much, isn't it? At least I do. So maybe the reason why you're in the session is because of that, and then you're probably fine with $5 of strike price increment. But if you were to be newer to trading, then maybe you are not fine with $5 of strike price increment. Why? Because then the risk of the trade is going to be $500 minimum. And while to some of you, $500 of risk may not be too much, it all depends on the account size and your personality and your way to look at risk. To some of you that may be in earlier stages or may have a smaller account and you want to practice, you may be like, oh, Jose, that was a great trade on Facebook, but I cannot execute because it's too much risk for me, right? So when I see those wider strike price increments, I got those two concerns. It's like, okay, maybe we find a good trade, but you guys cannot execute. If you are in those early stages of your learning, if that was the case. And then the second case is the liquidity issue, right? So therefore, when I see things like that, I'm always curious, okay? And I'm going to get a bit nosy here to go ahead and go explore what happens to the following expiration date, okay? And one or two more expiration dates and see what happens. And notice that in this particular case, the same thing happens. If I look at the next expiration date, we still have 305, 310. So then I cannot reduce my risk from 500 to 250. Still needs to be $500 of risk. And what if I look at the next one, instead of March 5, March 12, let's see, same story. Okay, so 305, 310. So again, this is something that every time you trade, every stock is going to be different. It basically depends on where is the UFO, right? So the nearer the UFO is to the current price, the more options you get. The further away the UFO is, the less options you get. But of course, don't ignore the UFO, because then you got odds against you. So we need, we talked about the concept of being adaptable earlier in the day. So what am I trying to do? I'm trying to be adaptable while looking for benefits. But in this case, I didn't find a situation where I could benefit from a now narrower strike price increment. I did not find it. So then I'm going to have to be adaptable and plan the trade, knowing that the risk of the trade is going to be $500. And unfortunately, some of you may choose to execute in a paper money account because it may be too much risk. Some of you may be happy with it. Again, my intention is to make as many of you as happy as possible. But in the case of Facebook, we're going to have to take a $5 strike price increment. We cannot make it less on the upper side with the red UFO. Okay, so that's it. So we know this. So let's continue the plan. Again, long stories, long explanations. This is important stuff. At least when I was learning myself, I would have many questions in the back of my mind when I was planning the trades by myself. And so hopefully all those thoughts that I share with you, one day you'll be planning a trade and you'll be like, oh wow, that's what I saw once in the session with Jose. And again, all those things will help you grow faster. Okay. So feel free to give me some feedback, okay? If sometimes I go a bit too deep, or you would actually appreciate I go deeper into certain things, guys, I'm here to help you, okay? So make sure that you share with me, how is it working when it comes to the coaching that you receive with us guys, and happy to redirect or modify anything to help you better. Cool. Okay, so that's it. So we have decided that we're going to use February 26 expiration date. Okay, so we have it here on our analysis tab. And what we're going to do, okay, is we're going to set our upper line above this UFO. Why? Because it's beyond 287 and we got two UFOs above. And then we also need to look at what about the bottom part for the Iron Condor, okay? Well, stats are telling us that the further up is going to go is 288, the further down is going to go is 245. Again, this is just a projection, an estimation based on probabilities. So it's very relevant, but it's certainly not a guarantee, isn't it? So 245 is more or less there. Okay, 288 is more or less here. So again, if I was to pick a UFO above and below that, so basically I would be here on the bottom part, and it would be 303 on the upper part. Now, current price is here. Okay, so I like to take this distance and project to the bottom part and see where that brings me, because if you think about it, it's actually smarter if I was to use the bottom part of that UFO. I could use the upper one, it's fine. But if I use the bottom one, I basically make my trade a bit better centered. Okay. And why is good to be centered? Well, because you give yourself a greater chance for price to fluctuate between that price area without being wrong. Okay, while you stay in a range. Because we are planning the trade today on February 4. The expiration date is 2/26. Right? So right there. Okay. So basically, so far, our bet is to have the price of that stock to stay within the purple box. Okay, that's our bet. So the wider the box and the more center you start, the less likely you will be wrong, and it will go either beyond below the bottom line or beyond above the upper line. Okay, and it stays in the purple area. So I got two choices on the bottom part with two UFOs. The most intelligent choice is the one below at 228.98. Let's call it 230. Okay, so if I go back to the option chain, 230 is here. Okay, funnily enough, the 230 being here also pays us more than 35 cents. And that's not why I said funnily enough. The reason why I said funnily enough is because the strike after is also $5 apart, like what we saw on the upper part above 305. Okay, so you know what? Even if we fixed the upper part, actually the challenge was also in the bottom part. What do we conclude? We conclude those strikes are far away. We conclude, therefore, that these, even market makers are not releasing too many strikes there because there is not much interest. There is not much open interest, and therefore, there is the liquidity issue, but also it's kind of a benefit somehow from a probability standpoint. It means that not too many people think price is going there, so not many of those options are being traded. Okay, so if we're gonna be selling those, okay, we are. We know it thanks to the UFOs and the statistical calculation we did, but it is looking like the trade will make sense. So with those parameters in mind, again, we're gonna start planning the trade. We'll start with a 305 on the top. Okay, so 305 on the top means that we're gonna do 305 and then 310. And on the bottom part, with the put side, we're gonna be focusing on the 228. I said let's call it 230. So then we're gonna do 230 and 225. Okay, so 225 and 230. Okay, and if we were to do that, okay, so the trade we got is gonna provide a credit of 32 cents. Okay, 32 cents. So is this something for us to accept? Yes or no? Okay. So again, I want to re-summarize very quickly the rules. Some of you, I would say most of you, should know the rules, but just in case. So rule number one is we need at least 35 cents for the strikes, for each strike we sell. Okay, and we did get that. Strikes we sell were the 305 call and the 230 put. Okay, so call and put. Okay, 305 and 230, and each of them were like 50 something cents, 60 cents. So they were all above 35 cents. So that's good. But then we have another rule that says that the net premium collected, okay, needs to be at least 15% of the raw risk. So what is the raw risk? The raw risk is the distance between strikes on the put side or strikes on the call side, which is $5. Okay, so the raw risk is 5, right? So how much is 15% of 5? Well, 15% of 5, it's double that amount, right? 15% of 5, again, not that we need a calculator to do that, but just to be visual, it's 75 cents. Okay, so to accept this trade, we need this trade to pay at least 75 cents. And so far, we can see the premium we would collect would be only 31 cents, which is really, truly disappointing. Okay, and by the way, this has a lot to do with the fact that strike price increments are $5, and some lack of liquidity is happening at those further out prices. Okay, so what do we do in a case like that? Do we just give up and go for another stock? We could. Okay, and nothing wrong with that. But we don't need to give up just yet. We can go ahead and check. Okay, well, 26th of February didn't work. Okay, but maybe 5 of March will. Okay, implied volatility happens to be tiny more. So instead of 32.46, we got 32.52. It's just a little more. Probably the following strikes are going to be even better. Okay, and the monthly, now that one is a 43-day iron condor, so it's a bit lengthy, but again, we're gonna keep going all the way to that expiration date to see if it's gonna work or not. So the first thing I'm gonna do using the next expiration date, which is March 5, is to go ahead and recalculate my probabilities. So March 5, and now we got 291, 242. Okay, so 291 to 42 means, of course, we are going to stay longer in the trade. So the stock could go further away, from the current price. And therefore, the probability is going to be less. But still, notice how the dotted line is far from our final line, far from the final UFO. And therefore, this trade would also make sense. So if I sell the 305 and the 230, the 230 would pay me 104, which is indeed more than 35 cents. And the 305 is also going to pay me 94, which is also more than 35 cents. So if I do that, how much I get paid in premium total? Well, now I get paid 50 cents, okay, which is better than before when we got paid only 30 something. So we got better, okay, and this is getting closer to be approved, but is not approved yet because the raw risk is still $5, and therefore 15% of 5 is still 75 cents, and here we only get paid 49. So not good. So what are we gonna do? Same story. Go for the next date. Okay, guys, please let me know on the chat box with a quick message if everybody's following. Am I going too fast? You guys with me as I change dates, why I do that, and you guys are following? I would love to get that feedback, guys. So looking at March 12th, you can see 158 for the 230. You can see 137 for the 305. So premium are good. So let's look at probabilities. So March 12th, it's bringing the dotted lines to 295 and 238. So 295, 295, somewhere there, and 238. Okay, of course, we are now planning to stay longer and longer, right, in the trade, and therefore what happens? Well, the statistical range widens, but still we are fine because our UFO are further away, isn't it? So what happens if we do the trade like that? Well, if we do the trade like that, this trade is now paying 65 cents, which is more than 50, but still less than 75. So we are still not accepting it, my friends. Looks good. Thank you for that, Christian. And therefore, we're going to go for the last choice, which is going to be March 19. This one is a monthly expression date, so we may benefit from a bit more liquidity. And also, it seems that there is a bit more implied volatility, so more people are eager to trade those options, and they are a bit more overpriced. Notice here, everything is $5 price increment, so there has to be more liquidity per strike. So let's see if this one is going to work. I would guess that yes, but let's confirm and let's not get excited. So if we do this one using March 21st, okay, we get 298 and 236. Okay, so 298 and 236. So if I do my lines, let me check that again, 298 and 236. So if I do my lines, 298 and 236, here's where the lines are. Something like that. Now, of course, we are using, what was the date again? March 19. This has to be a good trade, my friends. Okay, and this is probably another bad joke, but this has to be a good trade. And the reason why is because this happens to be Saint Jose Day. So it has to be a good trade. Not sure my jokes are too appropriate today, guys. But anyway, so now what happens? Well, of course, now the range has expanded not only vertically, but also horizontally. So we have more time risk. But in exchange for that time risk, how much premium we get? Well, we get $90 of premium, which is more than $75, which is 15% of the raw risk. So my friends, this trade is approved. We just found a proper setup on Facebook. I'm just gonna type it here, so that way we're gonna track this trade and talk about what can be done during the life of the trade and things like that. Okay, and it's time to go ahead and place an order and execute this trade. Okay, so how would you execute this trade? Okay, so let me give you some instructions. First of all, before we execute, everybody pay close attention. You need to understand the risk of the trade. This is a trade that has a raw risk of 5, as we discussed a few times. Of course, in the world of options, everything is times 100, so that's $500 of risk, right? So 5 is the most you can lose, but for you to lose 5, we get paid 90 cents. So what's the risk of the trade? It's $410 per contract, okay, if you use one contract. In other words, if that number here on the quantity is 1, and you get filled at 90, which is the midpoint, which you may or you may not get filled at 90. We'll talk about the price for the execution in a second. Then this trade got $410 of risk. If you were to do, not like that, sorry for that. If you were to do 2 contracts, then this trade will get double the risk, which is $820. If you do it 3 times, you got 3 times the risk, okay? So again, this is obvious, but for the ones of you that are newer to trading options, this is very important. That's why I said pay close attention. This is very important that you understand the risk attached to the trade. Okay. So this is the risk of the trade. Okay. Now I'm gonna go with one contract, and I'm gonna talk about two things. What if you are practicing this trade in a demo account, versus what if you are practicing this trade with real money in a real account. So when I click trade, okay, notice that when I run the sessions with you guys here, I use a SIM account. Okay, so depending on the brokers that you use, okay, and I am using TradeStation, so I'll tell you about TradeStation first, but I want to tell you more. So depending on the broker that you use, the prices you will get when you simulate your trade are going to vary greatly. Okay, greatly. So if you look carefully, the bid price of this trade is 99, the ask price of this trade is 79, and the midpoint is 89. So what happens if you do this trade with the majority of options brokers that are out there in the industry, and you do that in a simulated account? Well, you will get the midpoint. Simulated accounts for options with the majority of brokers give you the midpoint, which is a beautiful price, and we are going to attempt to get it. But between us, it's quite difficult to get that midpoint price, unless you are trading small size, one contract only, things like that. If you're trading larger size, getting the midpoint, it's difficult. Okay, it's difficult unless you are doing it on the S&P ETF and it's super liquid and things like that, right? So with stocks, Facebook is very liquid, but we are dealing with 4 contracts. So you got the potential slippage coming from 4 contracts. So it's slippage times 4, right? And that's why you see the bid price 99 and the ask price 79. Basically, that means that you get in now and you get out now, and you just lost 99 minus 79. You just lost $20 just to get in and out, plus commissions and exchange fees and so on. So we want to be careful with that. And that's why it's sensitive when trading options. It's not so sensitive when you trade stocks or futures or even Forex, depending on the products that you trade. But with options, it's very sensitive, and even more when you are doing trades like today with 4 contracts at a time, which is an iron condor. Okay, so in other words, how do we deal with this? Well, first, if you are doing this simulated with the majority of brokers, just keep in mind you're gonna get filled at the midpoint. So when you review your trades, when you make notes for yourself, and then at the end of the trade, let's say you made $89, well, just make sure you rectify that note and you conclude that maybe instead of 89, you just made 75, okay? In other words, you try to take those theoretical ideal prices to something a bit more realistic. That way, the simulated trading that you do is more closer to what you will get in the real world, instead of those ideal midpoints that you get in most demo accounts for options. Now, TradeStation, and I guess this is coming from a good intention, TradeStation is extreme, because TradeStation actually never fills you, when you do options trading, never fills you using limit orders. They only fill you using market orders. In other words, you would get the worst price every time. In this case, if I do the trade with TradeStation, I will get 79, which is the worst price. I will never get 89, 99, or anywhere in between. I will get the worst price. Why? Because if you place a limit order for options with TradeStation, the order simply doesn't execute. Okay, so you are forced to go market price. This has a good thing, which is, if you were to take this trade and then you profit, the profit was the lowest as possible, and it's like going to the gym and training with weights. So it's kind of a good thing. But at the same time, it's not realistic either, because sometimes, and we've done that before, we've planned trades on stocks that have good premium, but not so good liquidity, and still we've managed to get the midpoint or close by. Why do we get sometimes very good prices on stocks that are not so liquid? Well, precisely because they're not so liquid, sometimes, and this is not always, okay, and it has a lot to do with market trends and many things like that. But sometimes market makers want to help a certain stock to become more liquid, because they perceive that in the future many people will want the stock or whatever, and therefore, even though the stock is not liquid, there is not much open interest and volume, market makers narrow the spreads to motivate more trading and therefore attract liquidity this way. And therefore, stocks that are not so liquid, when you look at their volume of interest, happen to allow for good prices when you do the trades in a real account. Well, funnily enough, in this case, if you use market orders in a demo account, you get terrible prices. And in the real world, actually, it would be better prices than what you get in a demo account, which is normally always the opposite, right? The demo accounts are supposed to give you better prices than the real world. The real world is supposed to be more cruel, okay? Well, with options, it's not always like that, okay? So I'm giving you a lot of detail here again, because I'm going to go with market price because it's TradeStation and it's a SIM account, so I have to. So I'm going to be training with weights. If you are doing this in your account, just be sensitive on how your broker simulates the trade if it's demo. And if you're trading live, now I'm going to give you specific instructions to get the trade filled, okay? So again, in my case, I'm just going to go market, okay? And that's it. But before I do it, how would you do this trade if you were to do it live? Well, you would start with, the midpoint, which right now is 88, as you can see. You will start with the midpoint, okay? Knowing that getting filled at 76 is doable, okay? Because it's what you get with a market order. So you will start with 88, okay? Place the order, and you just wait 5 to 10 minutes. And if you haven't got filled, then you would drop it down. And then instead of dropping down to 87 and then 86, then I would just go down to, 85. Okay, and I will go 5 cents at a time because, again, the way, market makers often like to bundle and package trades and maybe take the other side often has to do with, prices which are, let's call it round prices. I mean, 85 is not round, but kind of. So I would just go like 5 cents at a time, and you do 85, you wait another 5 to 10 minutes. If you don't get filled, then you drop to 80. And I would not go below 80, knowing that the worst case is 77, okay? I would say, in a stock like Facebook, with a little bit of patience, 5, 10 minutes, 15 minutes, you should get filled. I would say around 80, 85 should be doable. But start with 88. You never know. And if you get those extra cents, and you do that a few times a year, at the end of the year, it counts. Okay, so I would just suggest that kind of approach to executing the trade. Okay. So I'm just going to go with market, execute the trade, and then I will look at the chat box because I see some typing. So I make sure I don't miss any question. Okay, so place order. You review the whole thing. Yes. Here we go. And now I got the trade here in the manage tab. Here we go. Here's the trade. Okay, I just got filled. Of course, in my case, you see minus 23 at the beginning. Why? Because I got market order, so I suffered the whole slippage. Okay, $26 of slippage. So, I mean, again, it doesn't matter. We got plenty of time until March 19. Okay, and what I like to do, though, is that, notice how TradeStation puts those different legs separately. You could certainly keep them that way. But one way maybe to understand the trade better is to, just drag them to be together. So that way, notice how TradeStation now changes the title to be Iron Condor. Okay, and the whole outcome of the trade is summarized right there in one row. Okay, so to me that's easier to monitor. You can always expand it as well and get the different legs. But again, this is just a little bit of a preference in my end. Okay, so anyway, the trade is in. We'll talk about it multiple times as we go. And with that in mind, I want to go ahead and check those final questions before we conclude the session today. So, Marie, this is true. I have tried it. You know what? I'm just reading you a bit late. I guess you are talking about the execution thing in the demo accounts. Thanks for your comment there, even though unfortunately I'm reading you late, Marie. But again, I really appreciate your participation. Joe, how are you, Joe? By the way, I sent you an email today. I'm sure you read it. What happens to the previous order? I don't see a replace feature. Oh, got you. Yes, there is. Yes, there is. So let me do it. So here's the Iron Condor that we simulated, right? Okay. So let's say I want to place the order, and I do trade. okay? And I'm just gonna go with a limit order, okay, which is not gonna get filled because it's a demo account. So if I click place order and then I click yes, okay, this trade is on the manage tab. It's there waiting under received, okay, it's waiting there on the received. So you can come here and right click, okay, and then you can cancel replace, okay, this trade. And when you do that, it opens here on the bottom part, and then you can change your price, and then you can place order again. And if you were to do that, 86 is about to become 84, as you can see. And that's how you replace your orders with TradeStation for options, okay? But you need to make sure that you move into the Manage tab, okay? And then you see it under Received. Leland got filled at 86. Beautiful. Good job, my friend. I said 85. You got 86. So that's well done, my friend. Very nice. Very good, everybody. So we are done for today. By the way, I'm going to cancel this trade here. So I'm just going to cancel order. And that's it. So now notice it went from receive to you're out. Okay. So we got our Aaron Condor that we got filled under position. The trade is in. You've been given your instructions and the rationale for the trade. And hopefully today's session was a good one for you guys. And you've learned many things. And now what I'm expecting from you guys is some time and practice and effort on your own, guys. And of course, we're here to support you. So any questions that you may have, just come back to us and feel free to ask. Before we go very quick, I would like to introduce you to a brand new section on our website. You guys go ahead and take a look, and I would welcome feedback at many levels. Okay, first of all, we are launching a series of new courses and many things that we are doing for our community. So delighted that you guys participate of any of it, that's for sure. But at the same time as well, no matter if you are keen to participate on any of the various components I'm going to show you or not, definitely happy to get some feedback from you guys when it comes to the way the information is presented here, and how do you think this will help anyone beyond the people that are already part of our community, guys. So I'd like to pick your brain in that sense, if you don't mind me to ask. Okay. So if you click Explore My Options, you come here, and as you know, as a company, we have apps, we have courses, and we are adding more specific types of coaching, as you are about to see. So when looking at apps, let me open the three columns: apps, courses, and coaching, so that way I can show you very quickly. Thank you so much, Luis and Marie. That means a lot. It's very nice to hear. Thanks for sharing. So again, when it comes to apps, I mean, nothing new. Auto Climate and Auto UFO. The one thing that is new, though, is that we are about to launch the apps for MetaTrader. Okay, so forex traders out there, traders outside of the US trading CFDs. That's going to be another possibility for you, as well as we are launching yearly subscriptions to our apps, which basically make if you wish, the monthly fee to be cheaper by subscribing in a yearly basis instead of a monthly basis. Okay, so you guys, just for you to know. Second aspect, it's a brand new offering of courses. We are adding a lot of tools to help you. So we are running a futures course, a forex course, a stock course, backtesting for you to learn how to take a methodology, practice it, and know what to expect from the methodology if you run it yourself, because different methodologies provide different performance possibilities, but also the same methodology applied by a different person, a different trader, because trading is highly emotional and trading psychology has a lot to do with trading. The performance is also different from person to person, even if it's the same methodology. So with backtesting, you learn what to expect from yourself applying a certain methodology, so you can build your level of confidence and be realistic when it comes to goals and approaches to trading. And then with the trading plan course, you can build structure around your trading activity, so you create consistent action leading to consistent result. With all of this in mind, we have a trading psychology course, a cryptocurrency course, and also a complete set of courses for options. With options, it's going to be multiple courses. But the three I just mentioned, the three on the top, as you can see, they're coming soon. So there is a wait list. You can just type your name there and we'll let you know when it's ready. Those three on the upper right are in the baking. Okay, all the other courses are ready. And again, we've been, in my mind, very reasonable with the fees because again, we want to help you guys, and based on your emails, feedback, and so on, there is need for this kind of training among many members of our community. So hopefully this helps you. Certainly welcome 100% the feedback of your impression as you see this, but also beyond that, for the ones of you that will be taking those courses, please get back to us not only with questions and we can help you better, but also what was your experience? How can we help better? Just give us some critique. We'd love to receive that. Okay. And finally, from a coaching point of view, we have also created a collection of different plans. So we're gonna do more and longer and more diverse type of sessions. For example, very soon we are about to start option sessions where every session will have to do with specific option strategies. Because of lack of time and because we do one session a week, really I never do trades such as calendar spreads, double diagonals. I mean, there are so many things we can do with options that we just don't have time to talk about because options give you options, right? So we're gonna add many more of those things, and you guys can participate of that. To be part of these programs, I mean, we will not discontinue what we do on the YouTube channel and Facebook and so on. So you guys are welcome to not to change anything. I'm just saying we add more things. We also have a way to subscribe to it, which is yearly. And again, the idea behind yearly is that it makes it cheaper for you guys, but also not only that, you got extra benefits, such as every year you are granted the access to a course, either live or on demand. That's your choice. So every year you get a course for free that you could utilize, as well as once a year you get one-on-one coaching time with our team. And again, you could book that separately as well, but this is included in your membership once a year. And finally, for the let's call it the super traders among you guys. I mean, super traders. I'm kind of using a little humor here, defining super trader as the ones of you who are using different platforms, trading different assets. I mean, some of you are focusing on trading in a way very simplistic, and that's very, very valid and the way to go to keep it very simple. But some of you, I don't know, maybe you have plenty of times, you are trading multiple assets, different styles, you have different brokers, different platforms. So again, we have created a membership called All Inclusive, where you get all the coaching, but you also get all the apps for all the platforms. You get access to all the courses including the courses that we have not released yet. They will be granted to you the moment they are released. And you get one-on-ones in a quarterly basis that are included as well in this plan. Okay. So again, nothing needs to change when it comes to what we're doing. All the sessions that we do in YouTube and public forums such as Facebook Live and so on will continue as always, but we're adding many more tools to keep supporting our community and taking things to the next level. And obviously you guys are welcome to participate of any of these. And please share your feedback because again, our intention is to do the right thing and to help. So my direct email is jose@traddictiv.com. If you want to just email me directly and tell me, Jose, you know what, I like this or I don't like that, or what about you do this, what about you do that, or hey, I've taken this course and I loved it or I didn't, or this is what I realized. Again, authentically interested in receiving positive critique, guys, so we can just keep improving and improving and improving. Okay? You guys take care. Thanks for your time, everybody. See you soon in the next one. Tomorrow, don't miss Becky with Solid as a Stock. And again, see you again into next week. Bye-bye, everybody. Take care.